Listen to this very carefully. In 2026, if you are buying a hotel simply hoping for a passive 5% yield, you are on a fast track to losing your entire down payment. Hi, I'm Jerry. After analyzing over 80 hospitality transactions across Asia and North America, I can tell you that the market has fundamentally shifted. The first pillar is operating income. In today's economy, a hotel must generate strong cash flow from day one to cover rising interest rates and operational costs. I recently saw a boutique hotel in Seattle fail because they relied on a future sale, while their daily occupancy fell below 55%. Operating income is your shield. It pays the bills, services the debt, and keeps the doors open during a market downturn. But cash flow alone isn't enough to build real wealth. The second pillar is asset appreciation. You must actively increase the hotel's value. We do this by upgrading the rooms, improving guest reviews, and driving up the average daily rate to boost the property's market valuation. Think of asset appreciation as your sword. It is the multiplier that turns a standard investment into a multi-million-dollar exit. Here is the secret. The most successful hotel investors in 2026 do not choose between cash flow and equity growth. They demand both. When you combine operating income with value-add appreciation, you create a self-funding asset that pays you monthly while building massive long-term equity. So before you sign your next deal, verify the current cash flow and have a clear physical renovation plan ready. That is how you win. If you want more institutional hotel investment strategies like this, hit subscribe and check the link below for our free checklist.